Jobs day like Bloomberg.
Stocks holding on to the green. Four is the magic number. That is what the market is priced in for rate cuts 2024. The Fed is in an awesome place. Not my words, but those of State Street. There you go. Irony, State Street Global Advisors. Tim Graff on the IB with me. We're in an awesome place in terms of the propensity for the Fed to cut rates because the wages are low. Great for volatility. Hell volatility. There's the opening bell. She strikes it out at green in the opening calls. The Russell is up by 0.8%. That is the broadening out trade. Euro flat 109.56. 10-year yield dips ever so slightly. It is the short end of the curve where you're seeing the real movement to the downside as the momentum is. This is enough to let the Fed continue with the trajectory. Is it the confidence that Powell needs to cut? Some people in the market says it delivers an assurity for June, which is what Lagarde intimated along with Powell. Crude down by 0.4%. There's one stock to open at the watch at the open. It is Costco, the big box retailer, posting weaker than estimated second quarter results. The margins also falling short of expectations. Abigail Doolittle is with me on the Costco trail.
Well, this is an interesting one, Manus, because the quarter itself was actually really pretty strong. The stock, though, is down 4.2%, as you can see. That's the worst day going back all the way to 2022, December 2022. Let's start off on the good and then move to the bad. So relative to the quarter that was, adjusted earnings of nearly $4 per share, beat estimates by 8%. Sales, though, there was a little bit of a miss there, $58.4 billion. This, even as same-store sales remain solid, as consumers apparently are still seeking value. The in-store traffic was really the driver as opposed to larger transaction tickets. That said, their e-commerce platform is picking up in part because of their digital app, and that is helping to at least drive an improvement for the big ticket items. So overall, the quarter there was not so bad. But in terms of what could be driving the stock down, Citi is saying that there's a lack of catalyst for the stock. Yesterday was at an all-time high, if you can believe it, up a whopping 62% over the last year. Baird is saying, commenting on that price action, saying that valuation is at a near an all-time high. And then we have some analysts saying that it's just not a good thing that they haven't raised their membership fee. Whatever the factor is, I think that it could be that massive rally into this, a good quarter, but maybe not the perfection, to your point, Manus, that some folks wanted.
Okay, Abby, thank you very much. Keeping an eye on those retail stocks. It's been a big week. Let's stick with the earnings front. Pivot over to Broadcom. The shares in the red despite increasing demand for its AI products. Investors are focusing on the company's chip sales instead, which fell short of the estimates, and that's the disappointing part of this report. Ed, what have we got this morning? Down 1.25.
Yeah, it's a real mixed bag. I mean, Broadcom did make an attempt to open higher this Friday. You can see that we're down almost a percentage point in the moment. The story is really simple, which is that there is an AI relevant part of Broadcom's business, and they've upped the proportion of sales to 35% this year, where they see growth coming from AI. But the reality is that it's bread and butter business, which is providing semiconductors for smartphones. They never name this customer, but Apple is their biggest one in North America. It's just not performing as expected. There is softness there. So in the fiscal first quarter, sales of $7.4 billion, below street expectations of $7.7 billion. But they were able to kind of reaffirm this full year fiscal 24 target of $50 billion of revenue. So it's a bit of a mixed picture. The after hours declines were more significant than you're seeing on your screen following the open. Where Broadcom is AI relevant, it does not make AI accelerators or GPUs like NVIDIA does, but it does make the networking gear that goes into the build out of a data center. So if all of this infrastructure spend is happening, then it's likely that there will be some feel good for Broadcom. And indeed, they said the contribution of AI will be 35% this year, up from 25% their previous forecast. But they're also in the custom silicon business. And if you think about the hyperscalers, those operators of data centers that are powering the training of large language models and now moving to the inference side, a lot of them are using custom silicon, the most obvious example being Google and the TPU. There could be some benefit for that if customers come to Broadcom and say, make us our own custom AI chips. The stock down 1.2%. Happy Friday.
Happy Friday, Ed. Thank you very much. Have a good one, Ed Ludlow. Let's get back to retail earnings. We've got Gap topping out the estimates for the fourth quarter, a sign that the recent turnaround efforts are beginning to bear fruit. How big a fruit bowl is it? Isabel Lee's with me.
Hey man, it's quite big because reports are actually positive. We have Gap shares surging around 8%. Gap reported fourth quarter EPS that beat expectations, and Barclays called this report encouraging. Shares are up. Now it pared back some of its gains. It's up around 4%, but still in positive territory. So we have Gap reporting an EPS at 49 cents. That's more than double the estimated 23 cents. Revenue also came in higher at 4.3 billion compared to the 4.2 billion estimate. So Gap is a big umbrella brand. Under it is its namesake Gap, Old Navy, Banana Republic, and Athleta. And for a while, all the brands are really struggling. But we have Old Navy and Gap seeing signs of progress, and that's why analysts are a bit more bullish. Unfortunately, Banana Republic and Athleta are still dragging down their sales and profits. But still, Jefferies calls this as the early innings of a recovery story, and Barclays says this is textbook retail recovery. So Barclays even raised its price target, as did Jefferies and as did Telsey. So Gap has been trying to really rebrand and revitalize its image. It hired a new CEO who's been in the position for a little over 6 months. We have Richard Dixon, and he's been trying to make waves. So for instance, he hired Zac Posen to really kind of make his mark in the fashion world into the brand. And maybe it's working, because ever since he took the role, Gap shares has roughly doubled since in value. And for the full year, though, it's not looking so positive, because Gap expects sales to be roughly flat from the previous 12 months, citing uncertain macroeconomic environment. But today is a good day for Gap, with shares still up, Manus.
Okay, Isabel, thank you very much. And another stock having a rough Friday. It's Eli Lilly. The company's Alzheimer's disease drug faces further delays in getting approval due to concerns over the drug's safety. What are those concerns? Alex Semenova joins me now. Alex.
Hey, Manus. Well, yet another regulatory blow to Eli Lilly's highly anticipated Alzheimer's drug. The experimental medication donanemab will be delayed past the end of March. This is as the U.S. FDA plans to call a last-minute meeting to review the safety and efficacy of the drug. This decision comes just weeks before the FDA was expected to rule approval on the drug. The agency said that it wants to hear from outside experts on the safety and effectiveness of it. This sent shares down as much as 2% in pre-market trading. They're down more than 1% here into the open. Eli Lilly was still up 34% year-to-date as of yesterday's close. That's thanks, of course, to the success of its obesity medication. And as such, analysts weren't too worried about this delay this morning. BMO said that despite the fact that this was a surprise, its broader thesis is still intact, with obesity medications being the core driver here. And analysts at Barclays said that donanemab is increasingly peripheral to the stock's narrative. Lilly said that there was no change to its 2024 fiscal forecast. Manus?
Alex, thank you very much. Alex Semenova there. Let's get a little bit more on this jobs report today. We're joined now by iCapital's Anastasia Amoroso and PGIM's Michael Collins. Looking at the two-year yield, this is what we're showing our viewers this morning, 445. We are down. This is the very short end of the curve, trading with a lot more assurity. Michael, Anastasia, good morning to you both. Mohammed El-Arian says this is an ambiguous report. Tim Graff from State Street is on the IB with me right now, saying this is an awesome position for the Fed to be in, because the wages are lighter than we estimated. The revisions help us. Michael, is the Fed in an awesome place to have the confidence to cut as soon as June? Good morning.
Good morning, Manus. You know, people love to criticize the Fed, but wow, you know, it's hard to look for fault in their behavior really through this cycle. They were a little slow to start raising rates. They'll probably be a little slow to start cutting rates. That's their typical MO, right? They kind of sit on their hands and they wait for a reason to cut rates, and they really haven't had that reason. The economy's doing fine, the labor market's doing fine, but inflation is moderating. Wage gains, you know, are all the way down to the 4s, and they were close to 6%, you know, year over year, just a couple of years ago. So everything's kind of moving in the right direction. The economy is stabilizing, moderating. Inflation is coming down slowly. I mean, it's really, the soft landing is fully priced in, and maybe justifiably so. So the Fed can be patient, they can wait, but remember, the risk of the policy mistake is not that they cut too early. I think it's that they wait too long to cut and cut too slowly. But so far, so good.
Well, let's take that over to Anastasia. Good morning to you. The risk is that, as Michael says, is that they wait just too long. And I had Citi here this morning saying they're still seeing the risk of a recession. But I take you back to 1995. It was a bull run. It delivered 28% return over the next 6 years through to March 2000 before the bubble burst. Anastasia, the effusiveness with which we describe these equity markets every day. I mean, NVIDIA is in a land of its own. But
Yes.
the bullishness in these markets, you know, is it beginning to look like something that has the hallmarks of a bubble?
Right, Manas. Well, on the surface, you would think it does, given just the rip-roaring rally that we had. But it's interesting. I was looking at the technical indicators for the market today, and specifically the relative strength indicator, and we have been near an overbought condition of 70 for about since the middle of December now. And so typically, you know, that overbought condition doesn't really last that long. Something happens to derail that, and you have a pullback. But we haven't had this time around. And when I sit back and think about why that may be, because I actually think the backdrop for the markets is just in such a sweet spot right now. Because on the one hand, if we have faster economic growth, if we have this growth reacceleration, which is clearly playing out, that's good for companies. That's good for revenues. It's good for earnings. It's good for margins. And that's why we've actually seen the earnings estimates for the S&P 500 firm up for this year and next. So that's great, and that negates some of the expectations that, well, we need the Fed to cut rates, because if we have solid economic growth, that offsets a lot of that. And then on the other hand, you know, if we do hit a little bit of a slower patch, then the Fed does have the ability to cut rates given where inflation is. And if they do cut, that would support the economy and that would support the valuations as well. So I think that's why we're not in a bubble, where we're just in this really nice spot in the markets right now, given those two conditions.
And I think you sum it up very nicely. You say we're in this sweet spot. Michael, you say we're in a 1994 to 1997 paradigm redux. For anybody that wants to tune in, there were moments of cutting and then pausing. There were moments of crisis in LTCM. There were various things that forced policy response in the 1990s. But the hallmark of that was cut and serious pause periods. And again, I would say to you is that we've had that narrative from the likes of Bostic, etc., coming out with it, and Waller, talking about 1995. So the market says 4 cuts. The building narrative within the Fed is that we're up for pause and maybe even 1 cut. Again, markets and the Fed are divorcing. We're spread. The spread is widening again, isn't it?
You know, it's not widening enough to really make a difference, Manis. I think if there's a mispricing, it's that, you know, the markets are only pricing in the funds rate going to 3.5, really, and getting stuck there for 10 years. And as Anastasia said, you know, the Fed has a lot of dry powder. But to your point, you know, everybody's anchor, man, is to assume when the Fed raises rates 500 basis points, you know, things come crashing down. But this cycle is different. It's probably akin to the mid-90s, and we do use that as a similarity because, you know, right after the kind of S&L crisis, you know, balance sheets kind of got cleaned up, and we had the GFC, we have a tighter regulatory environment, we just came through this brutal pandemic. We haven't had the time to kind of over-lever the system again. The private sector, including the financial sector, the housing sector, some of the big cyclical sectors like commodities and autos and housing and home builders, are delevered, right? So you don't have this kind of house of cards that normally builds up through the cycle, and then the Fed, you know, smashes it down with their rate hiking hammer. So the private sector is actually in really good shape. So yeah, we're thinking the Fed can orchestrate this soft landing, but they do have to cut. 5.5 is too high of a funds rate when the inflation is about half of that, right? So we've just entered the period for the first time this cycle where the real funds rate is significantly positive, right? So that's really what can start to bite over the next year if they don't move. But again, you know, I think the soft landing camp is really the way to go here.
Okay, well, we've got 2 full bullish narrative there. Yeah, you're right in terms of the real rates. Michael, Anastasia, stay with me. A little bit more work to do. Coming up, President Biden makes his pitch at the State of the Union.
My purpose tonight is to wake up the Congress and alert the American people that this is no ordinary moment either.
The latest from Capitol Hill, the conversation on Bloomberg.
My purpose tonight is to wake up the Congress and alert the American people that this is no ordinary moment either. Not since President Lincoln and the Civil War have freedom and democracy been under assault at home as they are today. Now my predecessor, a former Republican president, tells Putin, quote, do whatever the hell you want. I think it's outrageous, it's dangerous, and it's unacceptable. I know it may not look like it, but I've been around a while. When you get to be my age, certain things become clearer than ever.
President Biden jump-starting the 2024 presidential race last night at the State of the Union address, taking aim at Donald Trump and the Republican Party members over an array of issues, including foreign policy, immigration and the economy, and reproductive rights. An energized Biden also looked to quell the concerns over his age and mental fitness. Anne-Marie Hordern had a busy and long day yesterday. Anne-Marie, what do you think the outstanding part of that State of the Union was? What did he grip?
I think it was this one moment, and Biden has actually said this before, but he reiterated and saved it for the very end of the speech, Manus, when he said, it is not how old you are, it is how old are your ideas. In that one line, which is going to be a pivotal line he's going to take to November, he did two things. One, he addressed his age concerns, but he also wanted to put a different path forward than the former President Donald Trump, who overshadowed this entire speech. You know, let's be clear, this was a political speech. Many analysts I'm talking to say it was very partisan, and it was a campaign speech. He didn't mention former President Donald Trump by name, who's going to be his rival in November, but he kept saying his predecessor. And with a number of issues right off the top, whether it came to Ukraine and NATO, when it came to January 6th, and when it came to reproductive rights and abortion, he constantly tried to show how big the gap is between his vision and the former president's.
And I suppose the question is this, which of those translates down to those swing states, Anne-Marie? Because some of them are much more prescient issues in the swing states than others. The differential, which do you think cuts through is a phrase that we use with the electorate?
Well, I think it's very early on right now. Libby Cantrell of PIMCO was on surveillance earlier today, and she talked about the fact that it's really hard to digest what's going on in terms of policy, because at this point in normal American election cycle, we'd still be in the middle of a primary. But we've already had the general election cycle underway. And many would argue it's been underway since they last faced off against each other in 2020. So when it comes to these swing states voters, at the moment, Trump is leading Biden, according to our polling with Morning Consult, in all of these swing states. His biggest issue last night was going to be his age, given some of the damaging polling about the concern voters have about his age. In our swing state poll, 8 in 10 of these voters in these key battlegrounds say he is just too old to be elected. So Biden really wanted to show that he was up for the job. But the bar was very low going into it. When you look at some of the YouGov polling, only 16% expected him to come out like that. So he cleared that bar. The question is, can he maintain it?
Yep, let's see. As you said, it's going to be a long, long campaign. It's a very different cycle that we're going to be in through this. Anne-Marie, thank you very much. Anne-Marie Hordern in Washington. Anastasia Amoroso, Michael Collins, I'm my guest this morning. Anastasia, good morning. You say we're already preparing in some format for a Republican basket. The question is the momentum of that Republican victory in terms of whether it's a clean sweep is going to drive this narrative. This is the outperformance of Morgan Stanley Republican basket relative to Democrat, relative to SPOOS. How much attention are people paying this far out to positioning?
I think people are starting to pay attention, and you sort of wouldn't know it from looking at the overall markets because those are moving on growth and Fed policy. But as those baskets show, hedge funds, for example, are certainly starting to position for certain outcomes. So if we look at, for example, flows going into some of those Republican outperformer baskets, the positions are definitely picking up. And so the longs are picking up there, the shorts are picking up on the Democratic side. And, you know, you could make the case that some of the Republican baskets are also going up because they have a high degree of cyclicality. So when you look under the hood, it's things like financials, it's things like industrials that really comprise the bulk of those outperformance baskets. But at the same time, I think people are starting to think what the next administration is going to look like, and they want to pregame that.
And that could be a Democrat administration as well, Michael. And either way, the deficit, $1.6 trillion of a deficit. If both candidates are talking potentially about enshrining the Trump cuts or more Trump cuts and Biden maintaining the Trump cuts, along with both spending programs, we could set up for 2025 as being a pretty big year of tussle in the bond market, couldn't we?
Yeah, absolutely. I think it's increasingly difficult, man, as to figure out what the market reaction, what the economic reaction might be to whether you have, Trump or Biden in office for the next 4 years, because I think their policies, to a large extent, are starting to move together, right? You mentioned the fiscal side. I mean, I think in either case, we're going to be stuck with large, chunky fiscal deficits, a lot of supply. Maybe the rates continue to stay more elevated than I think they should be, and maybe that's the trade that's being priced in. But even on the toughness with China, even on focusing on domestic manufacturing, it seems like both candidates are kind of moving more into that same policy sphere. So it's really difficult to figure out. Like last time we had the big Trump bump, we called it, rates skyrocketed, inflation expectations jumped with Trump in office. And I don't know if you can really discern between them as much.
Okay, well, hopefully those nuances become clear. Anastasia Amoroso and Michael Collins, my guest this morning on Jobs Day. Thank you for your contribution. Coming up in the show, we'll set the agenda for the rest of the day with our trading diaries. Trading diary. This is what you need to watch out for next week. We have Biden proposing the U.S. budget to Congress on Monday. The numbers for February CPI, critically important on the back of the jobs report at 8:30 a.m. on Tuesday. VW Adidas report on Wednesday. Then it is U.S. PPI, retail sales, and another round of jobless claims next Thursday. The fissures in the employment landscape there. UMich sentiment comes out on Friday, rounding off the week. That was Countdown to the Open. I'm out for a week. I'll leave you in the hands of Danny Berger next week on Bloomberg.
We're 30 minutes into the U.S. trading day, and it's Friday, March 8th. And here are the top stories that we're following for you this hour. A higher unemployment rate. Today's payrolls report shows signs of a hot jobs market starting to cool. And yields head lower. Investors are starting to bet harder on a rate cut after that jobs data. And stocks in the green. The week has rung in fresh records, and that's despite some selling of big technology names. I'm Shonali Basak in New York. Welcome to Bloomberg Markets. Let's get a check here on these markets because we are indeed ending in the green. We have the S&P 500 up about 0.5% now, and it is reaching new records this week. And you also have here the NASDAQ 100 up about 0.4%. Similarly, gains in the Philadelphia Semiconductor Index, but something I've been watching very closely here is the outperformance in the semiconductors versus the NASDAQ 100. You have seen the NASDAQ lose some steam to give some share to its other rival in technology here. The two-year yield down about 5 basis points on the day to a 444 level. Just incredible when you think about where we start the week. We started above 460. We started last week above 471. We'll talk a lot more about where yields are headed. Now let's talk about that jobs report because that blowout report this morning, the U.S. economy adding more than 275,000 jobs last month. And Bloomberg spoke with Acting Labor Secretary Julie Su about the data in the last hour.
The jobs numbers continue to be very strong. The 3-month average is actually 265,000. So, we look at trends as much as we look at monthly numbers. And our over time figures demonstrate strong, steady, continued growth. Exactly what we want to see. It feels like the very definition of a soft landing.
Bloomberg's Michael McKee is joining us here with more because on one hand, even though you did see hotter payrolls, you did see a higher unemployment rate, a lot of interesting things in wages. How did you parse through the noise here, Mike?
Well, basically, you have to be a two-handed economist. Harry Truman's going to be mad at me, but there are arguments on both sides, and I think Mohamed El-Erian said it well in the last hour on Bloomberg TV. People will see in this what they want to see. Strong job creation, and even though December and January were revised lower, they were still very strong numbers. And yet we have unemployment rising as more people enter the labor force and more people report they are unemployed, which suggests they're not getting jobs quite as quickly. The number that seems to have impressed Wall Street, though, is wages down to a 0.1% gain from a 0.6% gain the month before, and that pushes the year-over-year number down to 4.3%. As you can see there, we're still seeing stronger job growth than we saw before the pandemic. So it's hard to say this is any kind of a negative turning point, but the fact that the numbers were a little softer than they were in January and February has kind of turned the market expectations around, and now we're looking basically, Shonali, at another 3 to 4 rate cuts this year starting in June. We're back where we started back in January before the payrolls report came out. Average hourly earnings giving a lot of comfort to the markets, even though on a year-over-year basis we're still running ahead of where the Fed wants to be. They'd like to see 3 to 3.5. We're at 4.3, but progress is being made.
If you're betting on progress here and the lower wages that you're seeing, or at least some cooling of wage inflation, how does that bode for future inflation data ahead? Does that give some fuel to the fire that perhaps inflation is a little more in control?
It does. It suggests that the panic we had after the 6/10 gain in January has been overdone. That was probably seasonal effects. And so if we're on this track down, a 1/10 gain is probably not going to be the same as we get next month. It'll probably go up a little bit. But we're not seeing wage pressures generated by what is still a fairly strong economy. And that's what the Fed wants to see. And so that's what the market wants to see. And they're happy today.
Michael McKee, we thank you for keeping an eye on all the data and ahead at the next set of data that will send the market flying once again. Let's look at the market implications now with Stephanie Gills, Head of Investment Strategy for Robinhood Financial. Stephanie, when you look at the jobs data in and of itself, on one hand, you see some cooling of some key metrics here. How do you think about that in terms of how you might think about future investments?
I guess it's a good thing, right? Like Goldie's in the house today. And we're seeing that, the market is cooling, the jobs data is getting still strong and stable, and actually with the revisions, we're kind of in the 2 handle for the last couple of months. Nothing is really alarming, but it's headed in the right direction, and I think that's what the market wants to see. I'm sort of in the camp that, I think it won't get worse from here. I think the market will stay stable. The one thing I am watching is the household survey was negative, and you are seeing Challenger layoffs rise a little bit, and so the other thing is earnings season showed us that there's probably going to be some more cost cutting, especially in certain sectors, and so I think all of this is playing out the way that sort of I am expecting, but I don't expect it to get so much worse that it kind of leads to recessionary vibes.
And that is what I was going to ask next year too, because on one hand, you said Goldie's in the house. The current data shows you some stability, even with some softening of certain labor markets here. But at what point do you start to worry that things might go quickly from okay to much worse?
I think you just have to watch the data. I sound like Powell, but I think you have to watch the data. And if you're seeing like the unemployment rate, I think gets to the 4s, and if it gets there quickly, I think, then you start to say, what's happening here? Like if you start adding less and less jobs, then yeah. But I think parts of the economy are also already showing that it's slowing down. Like the industrial sector has shown that pretty greatly, and the manufacturing sector. It's just the consumer has stayed really, really strong, and that's kind of kept the economy afloat.
You look at currently, it's almost like it's in the bag to get rate cuts by the summer. You see it in the Fed swaps pricing here. But what about beyond that? If you don't see 3 rate cuts this year at least, do you think the market holds up as steadily as it has been?
I think so. I think the market just has to get used to the fact that we're not in QE anymore. Like I still think there's this kind of recovery period from expecting the market to, expect that it's, we're going to kind of go down to very low rates again. I just don't see an economy that really needs to have low rates. And so I think there's, I actually think there's a chance that they don't cut 3 times, that they cut 2. Like that's sort of the thing that's the bubbles that's starting to form in my own mind.
Well, if they only cut 2, you have higher interest rates for a little longer than at least what was initially expected. Right. Which are the sectors that start to struggle there, given perhaps high costs of borrowing or being levered to areas that are slowing down, as you've been talking about?
I think the ones that have already been struggling, like we've been seeing in regional banks, we've been seeing in REITs, we've been seeing even in utilities, like all the things that kind of take on debt. Small caps haven't, they've been doing a bit better recently, but I think all that sort of can continue. But I also think it's about the direction. Like once expectations are kind of out there and fully discounted in, if we don't need to lower rates significantly because of a very slow economy, that eventually is good for the broad economy.
There are some serious conviction plays in the market right now. You see a bid in the 2-year, for example. You've seen it all week. Based on what we heard from Jay Powell throughout the week, based on the data we're seeing today, you seem pretty cautious in some regards here, that there's still data ahead, there's still things you're looking for. What are the critical points that you're looking out for to show for either signs of weakening here in the economy that could perhaps really throw a dent in some of the investment theses out there right now?
I think 2 things. One is the jobs data is really important, and following kind of the more frequent data before that, because I do think like really the economy will hinge on what happens to people and whether people get to keep their jobs, right? And then that will impact consumer spending and really everything that's been keeping this economy afloat. The other thing is just valuations. Watching valuations alone has never been a good sort of way to time the market at all, because valuations can go high for longer than anyone expects. But the one thing I do get worried about is that expectations rise and rise and rise for earnings growth, in particularly like parts of the tech sector. And is there just a point where it just needs a breather to kind of reset? And so those are the kind of 2 things that I'm thinking about market and economy-wise.
Stephanie, stick with us. That's Stephanie Guild of Robinhood Investments. Now, we are all going to take a look at the market here, at what's moving with Bloomberg's Denitza Saykova. Denitza, I know you're watching a few names in particular, some tied to earnings. What's up with Costco? Let's talk about the grocers first.
Yeah, let's start with Costco. The earnings report is not really bad. We obviously saw sales disappointing to what Wall Street was estimating. But what we're hearing from analysts is like this was a strong report, but obviously the expectations were very high. For example, Citi is saying that they don't see many reasons to drive the share price higher. What we're seeing, obviously, like Costco had a very strong run-up, and we're seeing same-sales store growth. But of course, royalty valuation are near all-time high. And I think analysts were expecting is that Costco could potentially raise that membership fee, which is something we actually didn't see. So that could be one reason for disappointment. And of course, we have seen a lot of retailers this season talk about price pressures and consumers feeling those price pressures. Most recently, we had Target say that consumers are stretched. So that could be another reason Costco is feeling that pressure.
We should say Costco shares down more than 5% on the day today so far, and it is the worst day that they have been having since late 2022. But you're watching some positive stories here, Denisa, as well. DocuSign, which recently had to say that it would be laying off some employees there, now facing a little bit of green on the screen here.
Yeah, DocuSign is having an amazing day after earnings reports that came above estimates. Of course, the stock has been struggling for quite some time. This was one of the big pandemic favorites. It saw an amazing rally during the pandemic times as everyone switched to remote working, and the company was doing amazing. Now we're seeing a little bit of boost after those job cuts announcements. The company is talking about growing internationally. The company is talking about AI. So we're yet to see if all those initiatives and cost cuts are going to continue to boost the share price.
Also rising today, Gap. Denisa, what are we seeing?
Yeah, we're seeing a great day for Gap. Obviously Gap saw a big change in leadership, and since that change in CEO for the last 6 months, the company has been doing quite well. Earnings per share came ahead of expectations. Of course, we're seeing some differences between the different brands. For example, Banana Republic is not doing so well, and Athleta too, but Old Navy, their namesake brand, is the one that's doing great. We're hearing great feedback from analysts. People are saying that this is a textbook retail recovery, sales are improving, inventory is improving. So we're yet to see whether that campaign of the new CEO is helping. Another thing is that they're investing a lot of money in marketing for all those brands. So perhaps some of that is already paying off for the company.
Bloomberg, Denisa Sejkova, we thank you so much for keeping an eye on the markets there. Now coming up, 2024 is shaping up to be a tough year for Apple. The tech giant entering a technical correction as worries are growing on slumping iPhone sales. We'll talk about those details up next. Stick with us. This is Bloomberg. Now, Bank of America is seeing tech stocks post their largest weekly outflow on record. And this comes as Apple shares enter technical correction. Bloomberg's Abigail Doolittle has more.
Yeah, I would say it's a little bit of a warning, Shonali, the fact that we have these big flows, but sentiment is still bullish. You can see the NASDAQ 100 up about 0.6% on the week, heading to a fifth up week in a row. But those flows, the biggest in a long time, meanwhile, the animal spirits stirring, but not for the biggest tech names. Take a look at Apple, to your point, down 4.6%, down another week in that technical correction, down about 14% from its December 14th peak, a real divergence from the markets themselves. Tesla down double digits, concerns for Apple include China. That's true too for Tesla, plus margins, pricing. And then take a look at Microsoft, down 1.3%. So two of the biggest member weightings to the NASDAQ 100 and the S&P 500 down, and yet you have those indexes higher, much of that having to do with NVIDIA. Relative to Apple, there are, of course, again, the China concerns that I mentioned. There's also, tying into the China concerns, the fear that iPhone growth is slowing down. I would say the biggest concern for Apple, though, and I think that this point can't be overestimated, really underscored, is the fact that Berkshire Hathaway last quarter started selling. The type of selling that we have seen yesterday, even though the markets were higher, Apple was down. That is consistent, heavy selling pressure. It speaks to continued selling. We don't know right now that it is still Berkshire Hathaway, but the fact that they started to trim in the fourth quarter of last year, why? It's probably the first two reasons. But when you have a big seller like that, it can take a long time for one of those positions to unwind. What does this mean for the NASDAQ 100 and some of the exuberance and yet the flows coming out? Well, take a look at this longer-term daily chart. You can see the NASDAQ 100 was trading in a range. Out of the range, take a look at these all-time highs. The RSI is heading down. We have lower highs. That tells you that we really are having weak hands buying, maybe two strong hands selling, such as Berkshire Hathaway. Of course, Warren Buffett, Shonali, is famous for the quote that the time to buy is when others are fearful, maybe, and then the time to sell is when others are greedy. Maybe that's what we're taking a look at here in Apple.
A lot of greed. Thank you so much, Abigail. We appreciate that so much. And we're going to welcome now back Stephanie Guild. She's the head of investment strategy for Robinhood Financial. And Stephanie, when we talk about Apple here and some certain very large names that have a lot to do with the performance of the S&P 500, the NASDAQ 100, and particularly that basket of Magnificent Seven stocks, how do you look at those things now?
I definitely don't think the Magnificent Seven is the only game in town. I'm actually calling it the Fab Five because two, like we just talked about, may be dropping out of that. But I think there's dozens of names, more than dozens of names that have done just as well, if not better, than the S&P 500. Actually, 180 names in the S&P 500 have done better than the broad average. And a lot of that isn't just in the Mag 7. Of course, the top three are, but you're starting to see movements in healthcare. You've got the theme of AI and GLP-1. I don't think that's going to go away for a while, but I do think that this is, and I feel like I've talked about this a lot, but it's a stock picker's market. Like, I don't think it's just the Mag 7 and look the other way anymore.
Well, how do you define the Fab Five, especially when you see the relative outperformance now that you're seeing in the semiconductor index based on that AI boom?
Yeah, it's basically dropping out Apple and Tesla because I think there are other issues going on there, and the rest of them I think are going to continue to do well for various reasons. But there are lots of idiosyncratic stories below that.
How do you think about those smaller cap stocks? We kind of talked about this a little earlier. There has been so much expectation in the market that when we think past that Mag 7, when we think equal weight, how much would it take for more love to finally flow into small middle cap stocks? On one hand, you have rates potentially cooling here. On the other hand, you still have some softening signs in the economy.
Yeah, I mean, small caps in general need a good economy, right? They're mostly financials and industrials, and that's the parts of the market that haven't been doing very well or doing the least well. And also they tend to take on more debt. So there's been, in the financial space, particularly not in the largest banks, we've had some issues, especially around debt. I think some of that stuff still needs to flesh out in the financial sector. In industrials, I think we just need to see the slowing end. And I do see a scenario where we don't reach a recession. We actually just have like the slowing ends. And then, these companies can start to come back because they look cheap.
When you look at the KBW Regional Banking Index, you did see a bid this week, and you saw it because, in part, of that big rescue you saw, the $1 billion lifeline, whatever you want to call it, to New York Community Bank. But still a lot of questions, a lot of troubles ahead. What would get you confident in financials at this point?
I just want to kind of see what plays out. At least, look, the large financials are going to be fine. It's the regional banks, the smaller ones, and I want to see what plays out with the commercial real estate sector. You know, we are just getting into more and more maturities coming, and if they are managed well and the risk of the, you know, the bank's balance sheets are managed well, which didn't really happen in the case of New York Community Bank, then I think we'll be okay. But I'm not sure about that yet. I feel like it's been something people have been talking about for a couple of years now, and it hasn't played out yet, but I still, it takes a long time.
So it could be years before it gets
I think so, and if it gets managed well, then we're fine. I still don't personally want to make big investments there.
So when you think about sectors that potentially still avoid in this market, as you kind of broaden the aperture, what do you still avoid?
I'm still avoiding REITs. I'm still avoiding utilities. I'm still avoiding like mostly banks. Like I just haven't really liked those sectors, and there'll probably be a time where they start to come back, and then I'll refresh my view on them. But I still am a better buyer of looking for growth, especially because the economy is slowing right now. I still think the GLP-1 and AI themes will continue. And then there are some great recovery stories, particularly in the retail space. I know we just talked about one, but there are, I think, you know, there's been a couple of names that we've seen.
What do you like?
TJ Maxx is a name that we like, particularly because the consumer is slowing. We've seen that in a lot of the earnings reports. But TJ Maxx is a place that, you know, sort of provides to the consumer that wants a better deal. And I do think that they'll start to recover more than they have. And then, you know, I like software utility companies. And I say utility companies, not the old school version, but things that you know, provide a utility to everybody, businesses and consumers.
It's worth talking about the consumer a little more here when it pertains to those retail stocks. You know, you look at the jobs data, you wonder what the impact of more unemployment would be. Put that on top of record levels of credit card debt at a higher interest cost than most people have lived through in the past decade, let alone many in their lifetimes, right? So how much does the consumer soften this year, and how much of an over effect, the hangover effect, will that have in the market?
It's a key question. I think I don't think that it's going to stop. I personally am in the camp that it's not going to soften so much that it starts to feel recessionary. And so I think the consumer that's why so much relies on the job market, but I think the consumer will mostly retain their jobs, be able to kind of continue through this period. And that's why I mentioned Goldilocks earlier, because I do think that there's a path for that. There is a risk that the job markets continue to soften. We saw in earnings that there were a number of revenue guidance misses and earnings guidance misses, and that means companies will probably just make sure that they keep their profits, and they do that through cost cutting. And so it just depends on the magnitude. Personally, I'm in the camp that it won't be enough of a magnitude yet.
Stephanie, we thank you so much for joining us on this very hot jobs day. Our thanks to Stephanie Guild, Head of Investment Strategy for Robinhood Financials. Now, still ahead, we're going to take a look at the companies making the most buzz today on social media. That's social climbers. Up next, stick with us. This is Bloomberg.
Great questions.
Time now for Social Climbers. A look at the stocks making waves on social media this morning. First up, regulatory delays for Eli Lilly. The FDA says it will hold a hearing on the pharma giant's Alzheimer's drug to determine how safe and effective the treatment is. The drug was widely expected to be approved by the FDA just this month. And next, Boeing is again in the news after a tire fell off a Boeing jet shortly after takeoff yesterday from San Francisco. The Osaka-bound United Airlines flight was delivered to LAX after the incident with no injuries was reported. And finally, Victoria's Secret is out of the bag. The lingerie maker is making a surprise warning to investors that it expects sales to drop this year as turnaround efforts have failed to take shape. Now, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up, we're going to get a read on the morning's jobs report from construction. The industry is also facing a lot of news around the jobs front and the manufacturing front. We're going to speak to Saint-Gobain's North America president and CEO up next. This is Bloomberg.
I know the cost of housing is so important to you. If inflation keeps coming down, mortgage rates will come down as well, and the Fed acknowledges that. But I'm not waiting. I want to provide an annual tax credit that will give Americans $400 a month for the next 2 years as mortgage rates come down. to put toward their mortgages when they buy their first home or trade up for a little more space.
That was President Biden addressing the high cost of housing last night in the State of the Union address. Now, meanwhile, another strong jobs report has signaled that the Fed cuts might have to wait. But again, that employment rate is also ticking up for unemployment. Now, let's get a read on that market. Now, with Mark Rayfield, the Saint-Gobain president of North America and CEO. Saint-Gobain is a French multinational company that makes building materials for commercial and residential construction in the U.S. and Canada. Now, Mark, when you hear the president's comments, you hear a lot of frustration from lawmakers about the housing market. How concerned are you about the direction of travel when it comes to new homes and the cost that it may provide to Americans at this point?
Well, first, thanks for having me on today. I mean, I think in general, we've been relatively upbeat on the housing market. We remain that in that stance. I think it's been very resilient through this cycle. Certainly with higher interest rates and mortgage rates, you've seen less people selling homes and moving from place to place and seen more growth in the new home builders, and you see that in their results. I think as we see, holding of interest rates or interest rates coming down, you'll see more engagement and more movement of people coming out of their low mortgage houses, going into new homes. I think when you get below 6% in mortgage rates, you'll see people start to re-enter the housing market at a greater rate. So it's in a very good state today. And I think what we see in the future for interest rates, for other activities in the marketplace will just make it stronger. So we've been relatively upbeat for the last couple of years. I think it's turned out to be accurate, and I think we're very upbeat on 2024.
It's a funny calculus, isn't it, Mark? Because on one hand, you could see more activity here when rates start to go down, mortgage rates start to go down. But on the other hand, you might see prices start to rise meaningfully as well when you're thinking about what people are going to be paying at the onset. How do you expect this all to play out?
Well, I think, obviously affordability has been a big issue, and we continue to have to build more affordable housing. I think that's a combination of not just I think the building materials are there, the home builders are there to build those. I think it's a combination of finding the land to do it, finding the communities and the regulations to allow it to be built in more places. So that's a big part that we all have to work on. But I feel like as you get mortgage rates dropping, you'll see not just new homes and the new construction going up, but you'll also see people start to move homes, and that will, I think, release a lot of supply in the marketplace and maybe hopefully tamper down some of the price inflation. It will also, I think, enhance renovation and remodeling.
Well, what does this mean for the job market as well? When you think about what your workforce looks like, it's interesting because you have more than 15,000 employees across U.S. and Canada. You're a French company, but U.S. is your largest market. Very sensitive to this economy. Jobs. How much can a job start to hold up in this market with the environment that you're kind of laying out here on new construction and new sales?
Well, obviously, I have to say, and I'm glad you asked, the 15,000 employees you mentioned have really delivered these fantastic results we've shown this past year and the past 3 years. So they're fantastic. They do great work. We really can't have more respect for what they've done and continue to do in a really very, very busy environment. So I think attracting, retaining talent has become more difficult in the past 3 years, but it really makes us as organizations become more sensitive to what that talent needs and what the market needs. And I think that we've been successful with that. But clearly, labor will continue to be a challenge going forward as it's a very tight labor market. I think 3.9% was the latest unemployment number. So it means I find it a positive because with a company with the right culture and the right engagement with your employees, you can attract that labor and it gives you a bit of an edge.
Well, what does it mean for how tight the labor market is currently and where it's going moving forward, particularly in the industries that you operate in?
Well, we've been a big advocate for manufacturing and construction. We think both those industries are great industries to get involved in. You can start at any level in those industries and own your own contracting business, your own construction business, go from a line operator in one of our plants to being in this seat right here. So we think that it's a really appealing market in both manufacturing and construction. And we're competing with other markets for that labor. But I feel that with the consistency of how our markets performed, we're a great place for people to look at to grow their career. So it's not easy, but that's why we have, we try to build the right culture and the right attraction for our employees.
When you think about that kind of war for talent still, how much does it still exist and how much pressure would that put on wages?
Well, the war for talent still exists. I think it's, the pressure's always been there a bit on wages, but the reality is what we see for employees today, they're looking for more than just wages. They're looking for work-life balance. They're looking for benefits. They're looking for a culture. They're looking for a vision and purpose that they believe in. And so you need to have that whole package going forward. And I think so I think that's the solution to solving your labor challenges. And it's an everyday battle. It's something you have to look at day in, day out, and you have to adapt as the market adapts. And you need to look for, I'd say I'll take the opportunity for a diverse workforce. Now this International Women's Day, I'd say that you need to make sure you're recruiting in a broad pond and making sure you're recruiting diverse talents. And I'm very blessed to have 4 fantastic ladies on my executive team. One runs my largest business, Carmen Bodden. One runs Canada, that we've doubled our size. Last 2 years, Julie Bonamy, and our HR leader that's integrated those 7,000 new employees, Magda Dexter, and a rock star of a general counsel, Latoya Hackney. So you need to make sure you're getting all of that talent into your business.
Now, we're all sitting, investors, corporate America, watching the Fed thread the needle here between the higher interest rate environment as well as a softening economy. To your point, the unemployment rate did tick up a little bit. Payroll stayed hot. At what point do you think that the economy would materially weaken? Do you worry that you go from a very gentle landing here to something that's a little harder? What are you looking out for?
Well, I think as a CEO, I live in a constant state of paranoia, like most, but my reality of it is I think that even through what has been viewed as a very uncertain economy the last 2 years, housing has resisted because there's a historic underbuilt demand in the U.S. of about 4 million homes and 2 million in Canada, and therefore we need to rebuild that supply. So we believe that even in uncertain economies in North America, we have great growth ahead. That's why we're building 4 new factories. We're adding capacity. So it's always uncertain what will happen, but I believe with what interest rates will eventually come down. That's what everyone's saying. So you eventually see positive on that, whether it's June or July or August, makes little difference because we're robust already. But so I guess my point is I feel like we're in a market that can resist a lot of economic pressures.
Mark, we thank you for your time and a view from the ground there on a very hot jobs day that we're looking at here in the United States. It's Mark Rayfield of Saint-Gobain, North America. Now let's get a quick check here on the markets as we're watching us end back in the green. Abby.
Yeah, we do have a bullish day here for us and a bullish week. It might have started off in the red, but we've had the last 3 days higher for the S&P 500, and on the week now up 0.8%, up for a third week in a row. That NASDAQ 100 up less, but up 5 weeks in a row. Take a look at gold, another record high, up 4.4% on the week. We also have the 2-year yield backing up about 8 basis points. We'll be taking a look at that in a moment. And Bitcoin, speaking of gold, digital gold above 70,000 as you were talking about. Crude oil, though, not participating, down about 2%, $78 per barrel. But mainly this board is risk on as stocks are higher and bonds are lower. As for that 2-year yield, let's take a look at the moves on the week because it's really been kind of an interesting one. So when Fed Chair Jay Powell was testifying, not too much movement, still higher on the week, but on the jobs report, the revision to January, the idea that maybe that means that hot CPI report, maybe that will be not revised down, but maybe it was sort of a blip. You can see the 2-year yield comes in on the week about 8 basis points to 446. Some movers on the day, of course, include NVIDIA up for 3.3%, up 7 days in a row, 24% higher over those last 7 days. That's after the big pop after earnings, so the AI
Abby, jumping in here, we had lost your mic. We'll get back to you a little later with those checks on the market, but stick with us for now because for now, we're going to hear from Larry Culp, GE CEO, and Scott Strasnick, GE Vernova, incoming CEO, about what's next for GE Aerospace. Stick with us. This is Bloomberg. It's time now for Wall Street Week's Daily. Yesterday, David Weston sat down with GE CEO Larry Culp and GE Vernova CEO Scott Strazik to discuss the decision to spin off GE's power business and opportunities in the energy transition. Take a listen.
Obviously, there's a little bit of political dysfunction relative to the budget currently in Washington. But what we shared with investors was very much that same geopolitical backdrop. Unfortunately, that may not get better before it gets more tense. And again, both here in the U.S. and around the world, our business supports the warfighter, in both configurations. And we know that there are advanced technologies that governments want to deploy or be ready to deploy over time, and that's where we're investing from an R&D perspective.
Aviation has, for many, many years, been dependent upon technology. What are the changes that you see coming down the pike for GE Aerospace when it comes to technology?
Well, I think the wonderful thing about a jet engine, and really the source of GE Aerospace's competitive advantage, David, is that it's no one technology, right? We need to advance material sciences. We need to master aerodynamics. We need to be able to integrate all of that capability. Advanced computational modeling and testing is an important part of product development for us. So we just need to continue to invest in that regard. Those capabilities apply commercially. They apply in the defense world. And when we think about the next generation narrow-body, be that in 2035, 2040, all of those capabilities are going to need to be brought forward in order to meet the sustainability and the efficiency goals we know the airlines and the airframers have in that time frame.
Yeah, going back to Scott's business a little bit, a lot of concern about sustainability when it comes to aircraft. And you're working, as I understand it, on something called RISE, R-I-S-E, as a new engine. Tell us about that.
Indeed. Well, let's step back for a moment. This is a business that has really been built developing generational improvements in sustainability in jet engines over time. But we've often not referred to it as sustainability. We really refer to it as efficiency. But every time a next generation aircraft comes forward, it's really the result of a next generation engine technology coming to market. And with our RISE capability, which is really about sustainable engines, that same model will apply. Now again, this is probably a product that comes forward in the 2035 to 2040 timeframe, but we're investing actively today in the technology building blocks that will allow us to bring forward that next generation aircraft, which will probably yield at least a 20% improvement in sustainability or efficiency, depending on how you look at it.
Scott, same question to you when it comes to power, technological development. What are you looking at? What is out on the horizon for GE Vernova?
There's a lot of exciting things. Direct air capture. How do we manage carbon? We've got a prototype right now that's pulling carbon out of the air as we speak. Small modular reactor, 300 megawatt blocks of power that we'll commission this decade that we think can transform the nuclear industry. Robotics and inspection technology with our wind business that ensures that every blade that leaves our factory has been fully inspected to get quality right the first time. Grid software, our Grid OS, grid orchestration system, as we say it, to really help our customers deal with the complexities in the grid today as more folks put solar panels on their homes and charge EVs at night, and there's more bidirectional flows of electricity. All opportunities, so a long list.
So, Laura, you and I have talked about it before. Every CEO, Scott and you, maybe your most important, most immediate task is allocating capital. Figuring out, do you keep it, do you invest it, do you return it back to shareholders? You made an announcement this week about returning to shareholders some capital. Give us a sense of why you made that decision.
Well, David, a lot of investors have been anticipating a significant excess capital position at GE Aerospace. And I love saying that because, again, it wasn't that long ago we were looking at a mountain of debt that we needed to knock down, and we did. But what we shared with investors was we think over the next 3 years, we probably have $34 to $36 billion of capital to allocate. We'll first tend to what we need to tend to from an operating perspective, organic investments, be it R&D, CapEx, or second order. But we're still going to have a tremendous amount of capital to deploy. And what we've said is we see 70 to 75% of that going back to shareholders by way of buybacks and dividends. The board just last week authorized that $15 billion stock buyback. That will leave 20 to 25% of our available free cash to reinvest inorganically. And I don't think we'll do a lot of big M&A to start, but you'll see us continue to do smaller bolt-ons that I think fortify our existing competitive positions.
I think a lot of people would hear that and say, well, that's really good news for the shareholders because they get more cash in their pocket that they can do with what they want. At the same time, it also indicates you don't see a lot of great investment opportunities out there for that capital, because if you did, you'd keep the capital invested.
Well, I think that we have reserved the right to explore those inorganic opportunities. But in many respects, David, the best investment that we can make is in GE Aerospace. And that's what you see with that capital allocation framework.
What about your capital allocation? What are you looking at, Scott?
A lot of organic growth opportunities. Again, when we think about the grid and the substantial modernization needed of the grid, we're going to invest substantially in capacity additions to do that. There is still new technology that needs to be advanced on things like direct air capture, things like small modular reactors, and the grid software that's critical to the future. That's really our near-term priority, is really investing organically and positioning this business to grow. And as we do that, first things first, we'll then evaluate some of these other things over time.
GE, General Electric, I can call it that, has been an icon in American business for a very long time. It has a rich history here. And I wonder, as we look at breaking up into now 3 pieces, what do you think, Scott, start with you, what do you think is left in the legacy of GE that will really continue with GE Vernova?
I've been with the company for 24 years, and I've been with the company this long because we've always had great ambition. We've always been in industries that matter. Our customers have always known that when they call, we answer the phone and we work it. And we've always been surrounded by great people. So those have always been common threads that I know will move forward with all of us, all 3 companies on a go-forward basis. At the same time, I think we've built a much more consistent operating system for how we want to run those businesses. And I know for GE Vernova, our focus on critical customer KPIs while protecting for long-term breakthroughs, and a lot of what we've developed over the last 5 years through the model and really the gift, frankly, that Larry has given us, we're just starting. We're still in the early innings of that, certainly for GE Vernova, and I have to expect there's still real opportunity for the other 2 businesses.
That was Larry Culp, GE CEO, and Scott Strazik, GE Vernova incoming CEO, with Wall Street Week host David Weston. And make sure to turn into Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. Now, Bitcoin hit about $70,000 for the first time ever earlier this hour, and at the same time, investors are putting a record amount of cash into BlackRock's Bitcoin ETF, ticker IBIT. The shares of the iShares Bitcoin ETF has now swelled to over $11.5 billion in assets. And joining us now for more on ETF Friday is Bloomberg's Emily Grafeo. You look at that chart there on ETF flows, though, and you see just how much BlackRock has been beating the pack. Explain how much love you're getting for the industry.
I mean, this is really unprecedented, Sonali, to see this much money poured into new ETFs. The ETF industry has really never seen 10